China, where they'll set the policy. Let's see whether anything comes. The bell has gone, and the first tick on the Nifty is below 24,400. 400 points gone on the Nifty. Well, now 24,424, 1.8% lower on the Nifty and the Sensex. Mid-cap index down 1.5%. The Nifty small-cap index is also down a similar amount, and the advanced decline ratio has 200 stocks in, nearly 300 stocks in the green, for close to about 1,900 stocks, 1,700 stocks in the red. Well, it's selling off once again. There is no sign of a recovery. It's still 24,400 on the Nifty. Sectorally, I think all the sectors, even defense. Let's just check the defense index. Well, defense is the only index which is managing to hold up in the green with a gain of about 0.5%. But all the sectoral indices are in the red. Banks are taking a hit. The Nifty banking index is down. L&T is your top Nifty loser, and that's down 6.7%. We've seen pressure in commodity names. Commodity stocks are selling off. There is no place to hide today.
Well, that's right. Just take a look at a few of the top movers here on the Nifty itself. The Nifty is down close to 500 points. The hope is that it makes a panic low in the first couple of hours of trade. Stocks under pressure. L&T stock continues to weigh down. It's down close to 7% now. So in a matter of days, it's lost close to around 16% of its market capitalization. Big downtick is what you're seeing out there. Interglobe Aviation continues to reel under pressure. Travel restrictions, higher crude prices, both of them impacting it. The stock has seen a big correction from the recent peak. Shriram Finance, the fear is that, in fact, the cost of funds could actually remain elevated. The RBI may not have too much of legroom to go ahead and cut rates from here on if the rupee is weak, if crude oil prices spike up as well. And that's why, in fact, that one as well is lower. Add to the list, Tata Steel as well as Adani Ports. Both of them are seeing some pressure in today's trading session. What's doing well? ONGC. That's a stock that's, in fact, moved up in trade today. So I think we should get ONGC up. That's up close to around 1%. Paras Defense stock up now 10%, bursting away as we speak. So that's the big outperformer this morning. Fundamental news flow in favor. Tejas Networks, 320 rupees stock just around 10 sessions ago. That's become a 520 rupee stock. That data play opportunity clearly playing out there.
They unveiled something at the Mobile World Congress. It was done by the Union Communications Minister Jyotiraditya Scindia. So first, there was that NEC order last week, which boosted the stock, and now this data center. And plus the fact that the stock has corrected so much from its highs of 1,500.
Right, we take that point, and a bunch of stocks that are swimming in my can right now. We do have a lot of these IT stocks which are finding some support. So Infosys, for one, is up around 1.5% this morning. Coal India is the other one, which is up around 1.5%. So old economy, or maybe the ones which haven't done too well earlier, are finding some favor. HCL Tech and Tech Mahindra are the others as well. But L&T is extending its cut, now around 6.5% lower. We are seeing a bigger gash on a lot of these, companies which we do believe could be impacted by the West Asian crisis. So Petronet LNG down another 6.5% as well. GAIL is down 3.5%. The aluminum pays, Nigel spoke about that earlier. Nalco up around 1.2%, 1.8% now. Solar Industries is the other one which is up 1.2%. And in the broader defense names, well, we've spoken about a couple of these larger players and names like Paras Defense. Look at Zentech, that's the other one which is higher as well. IdeaForge, a drone play, that's the other one which is higher by about 4.5% too. Some of the pure domestic plays doing slightly better today. Swiggy is one of them, which is up around 0.6%. But a big cut is what we're seeing across the board, with more stocks, way more stocks declining than the number of stocks which are advancing. In fact, that ratio is now 10:1.
That's right, Mangalam. Just a couple of quick points here. L&T, the stock has got an absolute bashing in the last few trading sessions. I think the technical factor as well is going to play out here, because now the stock has come down to its 200 DMA. You'll try to see some kind of a bounce from here. The bulls will want to defend this level. So L&T, if you pull up the chart, with its 200 DMA, you'll see it's pat at around the 200 DMA. So L&T is one stock that you want to keep a very, very close eye on, because it's reached a very crucial technical level. That's one stock. The other one I'm looking at is the Nifty Bank. I'm highlighting both these two because they're larger constituents of the index. The Nifty Bank has come down to around the 100 DMA. So you'll have to keep an eye out on that factor of the market as well, because that's the largest in terms of contribution to the Nifty. So keep an eye out on that. And finally, the tech index, which I pointed out earlier today, one of those bombed out sectors. You have the rupee that's open weakish as well, and it's already got sold into phenomenally. So that's why it's defending the recent low, which is ballpark around 29,800 or thereabouts. So just keep an eye out on the tech index as well. The big underperformer That's trying to put in a bit of a fight, but it'll require help from both L&T as well as the Nifty Bank, which are at crucial technical levels.
You know, we spoke about a bunch of these stocks. We missed the pharmaceutical space. Natco, for one, is doing relatively better. In fact, outperforming in this bombed-out market where they've launched a capsule in the US market for which the sales were close to around $3.2 billion. So that's one that stands out in terms of gains as well. So Natco, maybe along with IT, we could see some sort of, capital finding or looking at some sort of support in the pharmaceutical space as well. Also a rupee play, also an impact that we would see relatively immune to what's taking place in the world.
All right, let's invite Dheeraj Agarwal, Managing Director, Ambit Investment Managers, now joining us on the show. Dheeraj, first, you must have spoken to your team about the kind of sell-off that we've seen in the Korean market. It's got a lot of leveraged ETF positions. I guess that's being sold off. And it does create a lot of volatility, a feedback loop. What is your reading of what's happening in the emerging markets right now? And what are the implications then for India? Just talk about the near term now.
Yeah, so from an EM point of view, it's clearly a risk off. So EM is a lot more vulnerable to what's happening in the Middle East at this point of time. Both from the point of view of dollar strengthening, which is what we have seen in the last 2 or 3 days. Dollar is once again getting sort of a safe haven headwind. Second is a supply chain disruption and crude prices. All of this makes EM more vulnerable as compared to the Western world, which is why we have seen a little bit more sanguine reaction coming out of the US. But the EM markets, whether it is Korea or Brazil, Australia or India, all of them are falling a bit faster. I mean, Korea's 10% fall today and 5% fall yesterday should be taken in the context of the fact that 12-month Korea performance is 100%. And even after the current fall, the market is about 83-84% up on a 12-month basis. So it just went up vertically and it's coming down vertically at this point. But EM is worse positioned in the near term because of developments in the Middle East.
But in emerging markets, India didn't rise. But now it's participating on the way down.
Yeah, so we didn't rise because the segment of the markets around the world which has been driving the current bull market, we don't have any representation, right? So the last 1.5 to 2 years rally in the world has largely been tech, semiconductors, AI. I mean, we have none of those companies represented in our large cap indices. So we didn't go up, but we are taking the brunt of the fall. I mean, remember, India is amongst the most vulnerable countries to crude. I mean, we still have not been able to develop any amount of energy independence. 90% of crude is still imported. 40-45% of that comes to Strait of Hormuz. So we are in a slightly vulnerable spot as far as the impact or the shock coming out of crude is concerned.
Okay, all right. Got that. Hi, Dheeraj. Good to see you. And Dheeraj, since you briefly mentioned tech, which is a sector that's down, the index is down 20%, all of a month. You have the rupee weakness. And some of those companies, whether you look at the cash flow yield, dividend yield, or valuations in comparison to historic levels, it's looking relatively attractive. Will you start gradually allocating some money to these companies after the kind of fall that we've seen? And if yes, what would the preference be, large or mid caps?
So, it's a hotly debated topic even within Ambit. And I'm still a software bear. And my reason is very simple. What will AI change or not change may be clear or unclear to many people. But I think one thing which it clearly changes is it does improve the productivity by a factor of 4 or 5 as far as coding is concerned. So you probably require half the number of engineers to write the same amount of code. And how will Indian software companies readjust to that? The longer term, I think it will fall into place. Indian software companies can keep on doing more business without adding headcount, and hence the margin will expand. But in the shorter term disruption, how do you take care of the large workforce? How do you make sure that the revenue growth is so strong that productivity gain is absorbed? Those challenges are really structural in nature, in my view. So from the current oversold position, you might see some amount of bounce, some amount of stability, but I'm not bullish on the sector at all.
You're not bullish on the sector. That's about IT. And What are your thoughts on the consumption space now? A lot of people believe that maybe in the staple space, despite everything that the government has done so far, it's not showing up in growth numbers, even though the companies are increasingly optimistic. At higher valuations, the thesis is that why buy companies which aren't growing? So is there a case for prolonged weakness in the consumer staple space?
I would simply agree with that. So consumer staples has grown X growth, but the valuations have not gone X growth. Typically, these kind of sectors which have enjoyed a lot of investor love and extremely high valuations for decades, and not just years, take time to derate, and they probably derate more by stagnating and gently coming down rather than crashing, which is what we are seeing in the consumer staples space. But, for most of the frontline consumer staples companies, the volume growth instead of 4%, it becomes 5%. It's still very poor growth relative to the valuations they command. So I would agree with your view that they are in for a structural long-term derating.
What's the internal view, Dheeraj, at Ambit in terms of how bad does it get for India? I mean, do you, for the next 3-6 months, markets are headed lower? What would be an attractive point? Where does it end? Do you all have any thoughts?
Yeah, I mean, again, I must caution that at Ambit level, these are things which we're still debating and not crystallizing, but I can give you some of my thoughts at this point of time. Historically, we see India is traded in a band of roughly 12 times P multiple at the low and 26 times P multiple at the high. I don't think we go down to 12 because of the strong inflows into domestic mutual funds. That's something new to us. I mean, that is something which we have seen only in the last 5-7 years. And hence the base should be higher, whether it is 15, 16 or 17, we can sort of guesstimate around it. That could mean that Nifty tests 20,000 or maybe slightly lower in that broad range. Now, what would take the market there? And the answer to that in my mind is very simple. If this war simmers on, I mean, the headline war might end soon. So there's throwing of missiles at each other might end in a few days. But if the simmering of the war continues for the next few months, which means an occasional oil tanker getting attacked or occasional pipeline getting blown up, would basically mean the crude stays high for long, supply stays disrupted for long. If that happens, it will be very bad for Indian economy, and we could trade towards the lower end of the band.
So you're not ruling out a 20% correction from here? Sorry? You're not ruling out a 20% correction on the headline index, the Nifty, towards 20,000? Is that what you're telling us?
Yeah, I mean, 15-20% is quite possible. I mean, 10% I think is very, very likely. 20% is not impossible.
Oh, all right.
What's the probability you'll assign to this scenario? I know we're making this hard for you, but do you want to give your own personal opinion? A 10% correction and a 20% correction. What are the odds?
I think the correction for 10% is very, very high. 20% depends entirely upon how the events in the Middle East unfold. So I will keep that in reserve, but the probability of a 10% correction from here is very high.
10% correction?
Events which are unfolding at this point of time is significant. This war is a lot more significant than, let's say, Russia-Ukraine war or Israel-Gaza war, because you're in a very, very sensitive oil producing and oil transportation region of the world. And it's not that easy to just finish it off with a few bombs and a few missiles here and there. So I'm a little bit more worried about this war than I was worried about the last two. Last two, I was of the opinion that it will not disrupt global economy or global supply systems in a large way. But this one worries me a little.
Well, that's a very important point that you're making. 10% from here on as well, the probability is not very high because we've already seen a near 8% correction at an index level. Individual stocks obviously have seen much, much more than that as well. I mean, the rate on the mid-caps right now doesn't look like the Nifty is still at 24,330, despite the correction that we've seen. It's more like 21, 22, thereabouts. And as we speak, there is a fair amount of decline that we're seeing across the space. So we'll monitor that as it comes, Dheeraj. But, do you have a sense on what would lead it lower? Because IT, a large part of the index, has already seen a big correction. Financials relatively stable, a large part of the index as well. Reliance is the third part, which has already seen a correction from its highs, hasn't done much, in fact, consolidated a bit. So what is it that will take the market lower from here on? Is it going to be more of the same?
You know, anything can fall at 10%, right? Even the companies with strongest earnings can fall at 10% if there's a risk-off environment. So I know 10% sounds large in the context of the low volatile environment Indian markets have seen in the last few years, but it's actually not large if you actually stretch the whole market analysis to 20 or 30 years. If you stretch the whole Indian market analysis from, let's say, 1990 onwards, when liberalization started, almost every 18 to 24 months, we have seen 20% cuts in the market. Last 18 months or 24 months have been slightly different because of huge influx of domestic liquidity. Our volatility was actually lower than that of the US in the last 2 or 3 years. So I think we're just returning to the similar volatility as we had seen in the past. I mean, I wouldn't hazard to guess what drives this 10%. I mean, anything can fall 10%. I mean, banks can fall 10%, Reliance can fall 10%, anything can fall 10%.
Dheeraj, what's prevented the Indian markets from seeing steep declines in the last 3, 4, 5 years has been the DII participation. And you said this has been a new trend, which is why we can't give historical comparisons of the low PE seen in the past during crisis times. Do you not think that DIIs will step in aggressively retail participation if there is a sharp correction?
Yeah, it's see, it's a matter of perspective. According to me, 10% is not that sharp.
Yeah.
I mean, I'm not talking about 30%. And if all the institutional investors also see a possibility of a risk of an 8-10% correction, you just slow down your purchases, right? I mean, it makes sense because your primary objective is not to support the market. Your primary objective is to generate positive returns for your investors. And if you can see a large amount of risk on the horizon, you could just hold back on your cash a little bit longer.
So are you all increasing your cash holdings? What are you all doing?
Sorry?
What are you all doing then with the money?
No, I mean, we by our mandate, we're not allowed to stay in cash, so we stay fully invested. But I'm talking about mutual funds who typically sit on 5, 7, 8% cash at different points of time. And also, inflows in mutual funds have slowed down, FIs sales have restarted, so the inflows in the mutual funds get now offset by the FI sales again. After $2 billion inflow in February, the first 2 days of March itself, we've seen fairly large outflows. And if that continues, if the weakness in rupee continues, which is linked very highly to crude, which means FPI outflows can accelerate. So there are a number of moving parts at this point of time. And in a risk-off environment, just the buyers step back, FPI increase, they're selling a little bit more, and 8-10% can happen fairly quickly.
All right, Dheeraj, great conversation. Thank you very much for sharing your insights. For the market, once again, drifting lower, 24,350 on the Nifty. It's a 500-point fall on the Nifty. The Sensex down close to about 1,700 points. The mid-cap index, small-cap index also lower by nearly 2%. And remember the fall in the currency, the fact that the currency has hit a record low, crossing 92, is not helping. Only 2 Nifty stocks currently in the green, and those are Infosys, Coal India. And on the way down, L&T has breached the 200-day moving average of 3,810. That's a 7% slide. Tata Steel has plunged 5%. Shriram Finance, 4.5%. Interglobe Aviation. Many of these travel tourism stocks have been hit for the last 2 days. And you can see continued sell-off even in Adani ports. So maybe the entire logistics space also gets impacted because of supply disruptions, and that could be hurting Adani ports this morning. IT is not providing too much of a support, but at least it's not falling. But let's talk about Interglobe Aviation.
Yep, let's talk about Interglobe Aviation, down more than 4%. Vinny joins in with the latest insights on what brokerages are saying about the aviation sector. Vinny.
Hi, morning. So in terms of Interglobe Aviation, do not forget we have the domestic air traffic data that came in for the month of January as well, which was decent, 7% increase on a month-on-month basis. Passenger growth also increased for Indigo, Air India, as well as SpiceJet. But obviously, that is in Jan. Now, in the current scenario that we're seeing coming in, HSBC has written a note on this aviation space as well. They said that geopolitical tensions have forced Indian carriers to cancel all the flights in the last few days that we've seen, and especially to the region and some parts, Middle East region, and some parts of Europe as well. So what is the impact in terms of capacity? HSBC highlights that 20% of capacity for Indigo, that as well as 32% for SpiceJet and 40+% for Air India could be affected because of this. Now, already we are seeing 5 days going into this as well. So we could see that impact coming in terms of traffic data, the numbers for these companies as well. Apart from direct losses due to cancellation, also spike in oil prices. That becomes a concern, and that's an important one. Crude oil prices rising, oil prices rising will impact the profitability of the company. So this is some of the risks that comes in for these companies, aviation space specifically, and that's the highlight coming in from HSBC.
Take that point. Thanks a lot for that, Vinny. You spoke about the aviation space. In fact, travel and tourism is one sector which is impacted or expected to be impacted by tensions escalating in West Asia. Let's discuss this further with Puneet Chhatwal, who's the MD and CEO at Indian Hotels. We focus obviously on the impact of the West Asia conflict, international business outlook post this conflict, and the impact on air catering as well. Thanks a lot, Puneet, for joining in. There are uncertain times for the world, and as I remember, you do have 3 properties in Dubai, Taj Dubai, there's Taj Exotica and Taj JLT. Let's start by decoding the impact of that across the board for you. On the one hand, there would be obviously the local impact, which is limited to just 3 hotels right now. But the other, if this prolongs, there could be an impact on international tourists coming to India or, all the other places as well, international travel, which could be an impact. And finally, your air catering business too, which is about a little over 10% of your revenue right now. If you could start by decoding the impact of the last few days and what it could mean for the company if this prolongs.
Good morning, Mangalam. There is certainly an impact. The good news is that everyone is safe, guests and our associates. The impact is more significant in Dubai than in India at the moment. But yes, there is disruption in air traffic when it comes to international passengers. I have a lot of requests coming in directly to me for people who have got stranded in India and want to go back to Europe, if they could extend their hotel stays and what we could do for them on a special need basis. So there is certainly an impact. But I also have to say, it's very strange. We started the financial year in April with Pahalgam and then followed it with Operation Sindoor in May and the airline accident in June. And now we are ending the year with geopolitical tension, which we have not witnessed in this scale, and that too very close to India.
Right. So, if you could draw upon some of the financial impact that you saw at the start of this financial year because of these, tensions that we saw in the country, and as a result of which, if you had to extrapolate the impact that could happen at this point as well. Obviously, it's good to know that all your guests, employees, associates, everyone is safe. This is a human crisis, and hotels, to give them credit, they've been very, very supportive. We see posts on social media, etc. as well, where they've been fairly supportive of stranded tourists. But all of that does come at a bit of a cost. Not the perfect time to discuss this, but an important one nevertheless.
Yeah, for sure, Mangalam, the year has been as volatile as it could have been. I mean, it must have had an impact of 5 to 7% on the top line for us, despite the fact that we have been, guiding and posting a double-digit growth, pretty high. We still feel that we'll end up the year north of 14% for the year, including in flight kitchen business. It could have been much higher because the demand has been very strong. So the good news is that despite all the challenges we have seen in the last 12 months, the sector has demonstrated resilience and it keeps coming back. Just like you just now showed some airline figures that there has been growth in Jan in 7% in air traffic, as an example. So for us, Jan was good, but February was outstanding. And we don't see the domestic demand or cancellations in the way we have seen cancellations for Dubai or the rest of the Western world.
Right. And it's not only an impact on flights to Dubai, it's also an impact flights through Dubai, right? The thing that the hospitality sector has been grappling with right now, post-COVID, is that international travel hasn't returned to India in the way it was pre-COVID. And that was one of the deltas for the sector, which could have driven higher room rates, etc. But with this happening, do you think that gets pushed down the road?
Absolutely, it will be pushed on the road. So there is the bad news is that the international foreign tourist arrivals never picked up the way they should have post COVID. But also that has some good news that there is not much needed to replace that business, which if it would have been very strong. So I think we were lagging behind and we continue to lag behind. And the majority of the seasonal traffic is over, which is October to March is when you get the majority of the international traffic coming in. So we got our very good share through the government delegations. You know, we just finished the Canadian Premier's visit at Taj Mahal in Mumbai, or we had, German Chancellor, British Premier, AI Summit got in so many heads of states. So I think all in all that helped the numbers of foreign tourist arrivals, but because we are coming at such a low base, the impact of foreign tourists going down does not help us to cover that delta, as you said, Mangalam, but it also is not that we have a loss of business in a very significant amount.
Right. And finally, just to wrap this conversation, impact on Middle East, yes, there is some, but limited to you guys. And despite, the kind of geopolitical tensions that we've seen, your revenue over the last 1 year has been impacted only by 5 to 7%. It would have grown a lot higher had it not been for these things, but growth nevertheless is there. And let's end this conversation with that growth part itself. This quarter is a strong one for MICE as well, meetings and weddings, conferences, etc. How has that part played out so far? And are you reasonably satisfied with all the other parts barring this?
Well, Mangalam, nice that you said, let's wrap this up, and let's wrap this up on a positive note. It's been a very good start to the last quarter of the year. So Jan and Feb have been good. I see no reason after the disruption, unless, something major happens in terms of this geopolitical tension, taking a totally different dimension. I have no doubt that the domestic demand, which has been very, very resilient post-COVID, will help us sail through with a good finish to the Q4 of this financial year.
And the current crisis does not impact your hotel signings and openings that you've lined up for West Asia, right? If you could throw some light on that.
What answer you're looking for, Mangalam, but our signings and openings, this is the strongest year in the history. The number of hotels we signed equals maybe the number of hotels we had 8 years ago. So the total signings in 1 year exceeds the number of hotels we had in the portfolio. So that way the going is strong. And if we take a breather or a pause for a month or a few months, it does not change anything in the openings. We'll be opening. We have opened 2 hotels this month already till the 4th of March, and we will open another 3. But all on the domestic front. We might end up delaying Frankfurt by a week or 10 days so that it goes into, post-Easter in the month of April.
So it's supply and signings delayed, not supply and signings denied.
Absolutely.
Take that point. Good luck. Once again, wishing that all your employees and guests are safe amidst this crisis, along with your leadership teams, etc., out there as well. And the impact is limited to the financials that we speak of. With that, we'll take a short break, come back, the discussion around shipping and rice sector and the impact following the US-Iran tensions for you.
Welcome back. This is Corporate Radar and you're tuned in to CNBC-TV18. Well, keep an eye out on the index. The problem is, the Nifty Bank that continues to see a lot of selling pressure, and that's down 1,200 points. Remember, the highest amount of FI weightage is on the banking names. And because of that, in fact, the markets are seeing a lot of selling pressure. However, a few stocks are trying to put in a bit of a fight. Let's pull up a few of those names. Bharti Airtel, I think it's seen more than a 10% correction just in the last few days. That's recovered close to 2% from the day's low. So Bharti Airtel is one stock. Big boy HDFC Bank as well was down close to 2.5%. Now that's cutting its losses, and that's a large weight. So that's why we're seeing some bit of a pullback out there. And Eternal as well has cut its losses. That stock as well has moved up a little bit. It's on the verge of moving into the green. So keep an eye out on that one. And as I mentioned earlier today, the tech stocks could actually be in focus because they've actually got sold into, it's underperformed big time. The rupee weakness could play out in their favor as well. So for the time being, that is the outperforming index today. The tech index up 0.8% in a market that's a little bit wobbly. But the broader markets, I think, are calling for attention. As of now, only 330 stocks are advancing. That compares with 2,500 stocks that are declining. Let's move on then. US President Donald Trump has said that the US Navy will protect ships in the Middle East if the need arises. That's if it's necessary, in a bid to stop the energy supply crunch sparked tensions in the region. To discuss this, how will the conflict disrupt global shipping and impact on Indian rice exporters as well, we're now joined by Sunil Vaswani, the Executive Director at Container Shipping Lines Association, who joins in. And a short while, I think we'll get the management of KRBL as well. Good morning, Mr. Vaswani, and thanks a lot for joining us here on CNBC-TV18. Well, very, very tricky times going by the geopolitical issue. It's clearly plaguing a lot of sectors, and in particular, the shipping industry. Give us a sense about what feedback you've received over the last few days in terms of the routes, the traffic, the insurance as well out there, a broad feedback.
Morning, and thanks for having me here. These are indeed unprecedented times and a matter of concern, though, for everybody. And as shipping lines, we very well realize this. And let me assure everyone that we are doing all we can to assist the trade. Having said that, over the last few days, we've suddenly seen an escalation in conflict. And as a result of that, the shipping lines were forced to suspend their services to the Gulf ports. But on the other hand, as far as the main routes are concerned, the long-haul routes are concerned, to the US East Coast and Europe and the Med, for instance, the services continue. Although some of the lines may have had to adjust their services and deployment, but the services do continue. So let me take you back to the COVID period. Even those were very unprecedented times. But over the last 5 years, we've seen quite a few situations where we have eventually got over those situations and handled the business effectively. During COVID also, suddenly COVID struck, as you know, and then there was heavy demand for capacity. So initially, of course, the freight rates shot up and everybody was running helter-skelter, the shipping lines for capacity. But eventually we did find capacity and we put in the additional ships. And the services were brought into place and everything worked out well, even as far as the rates are concerned. Then more recently, 2 years ago, when the Houthis struck at Bab el-Mandab, we had to discontinue our services over the Suez. And we started moving our ships over the Cape of Good Hope. So ever since, we put in additional capacities and the ships have been moving over the Cape of Good Hope. But a couple of lines had reverted to sailing over the Suez. Those lines have now been forced to move over the Cape. But having said that, what I'm trying to drive at is that the situation is not as bad as it seems because we have the experience as shipping lines to deal with these situations. We've already put our capacities over the Cape by and large, and those who haven't, they have just started moving over the Cape. So things are more or less under control. But as far as the vessel scheduling is concerned, yes, that will be a bit of a challenge, but we will work around that as well. Thank you.
Just for simplicity, Mr. Vaswani, is it possible to say what is the percentage of cargo which is stuck right now, and what is the percentage which has been rerouted through the Cape? Is it possible to give that number? And then also the cost of travel, the increased travel and insurance, that has gone up for the Indian companies. If you could give a number to that, yeah.
Sure. So the insurance cost, of course, has gone up. And I would say the cost of bunkers, for instance, that's definitely gone up. Over the last 1 month, has gone up from $60 to $83. So that's a significant rise in the cost of bunkers, so cost of oil, which increases the cost of operations for us. As far as the cargoes that are stuck, see, essentially we're talking about cargoes to the Persian Gulf. Cargoes, containers to the long-haul destinations in the US, Europe, Med, those are moving. So Persian Gulf, of course, that's something that we'll have to work on, or we'll have to see how to get about it. But most of the cargo, I would say, is all moving because it's going on to long-haul destinations. Now, if you speak about the cost, if you see during COVID, the cost at that point of time had gone up also significantly. You had gone up to from $600 or $700 for Europe, say, for instance, then went up right to about $6,000. And then suddenly after that, came down to about 1/10 of that, and then again started going up during the Red Sea crisis. And we've practically come down almost to pre-COVID levels just before this situation arose. What I'm trying to drive at is that initially, any situation, there will be an impact. But then eventually, when you start working around it, things come down to normalcy. So that said, I would say that, there is a cause for concern, certainly, but there is no cause for panic.
All right, we take that point, Sunil, and when you started the conversation, you said these are unprecedented times. What we've learned over the last 5 or 6 years is that the usage of the word unprecedented has itself been unprecedented, because we've gone through COVID, we've gone through multiple geopolitical tensions and tariff tantrums and so many things, right? So perhaps the street has learned to live in the VUCA world, as we call it. But we also have Akshay Gupta, who's the business head, bulk exports at KRBL, who joins in. Akshay, rice is an important commodity which has been exported to West Asia, not alone Iran. If you could give us a sense on what yours and the industry's exposure to that region would be, and what the impact over the last few days has been, and what is it likely to be over the next week or so?
Sure. Hello. So, Middle East and West Asia, I think, accounts for more than 65% of India's exports of basmati rice. So it is one of the major regions of our customer base. And, it's a big impact. It's a big impact for the entire industry. Moreover, it's the season of Ramzan where the maximum consumption happens of basmati rice. So January, February and March, these are the peak seasons where the maximum supplies happen. And at this time, facing such a turmoil is hampering the entire supply chain, from production to shipment to, customers base. So I think this is the biggest impact that the industry can have.
What's been the increase in the price of basmati on account of this choke?
No, so prices were increasing up till 15th of February, or maybe 20th of February as well. We were seeing all-time high prices. But right after this war was announced, we've seen a sudden drop in prices because everyone's worried about Iran. Iran is the biggest market for Indian basmati rice. It's the biggest importer of Indian basmati. So suddenly prices have dropped by about 5 rupees a kilo, which is about $50 a ton. So, and now the only question in everyone's mind is how long this war is going to last. So the duration of the war is the biggest concern.
Right. So, Akshay, you're saying there's been a drop in prices by, how much did you say the drop in prices was?
$50 per ton in the last 1 week, yeah.
$50 per ton. And what are you doing with the excess capacity now, since you are unable to export to the Middle East?
No, so on an immediate basis, we've just stopped all our production of units or production orders for the Middle East, and we're just focusing on other countries at the moment, because shipping lines, insurance, everything is a concern. Till we get clarity on that, we will not make shipments. So everything is at hold right now. We have about a big quantity of stock at our Kandla plant, which is being put on hold. Right. It's a matter of time. If in a couple of days we see something ease up, we might continue shipments. Right. But if this goes longer, then it will be a big concern.
Hi, Akshay. Good to see you. And Nigel on this side. A quick question. 60% of rice exports, go to the West Asia, I think is what you said, right?
Middle East West Asia.
Middle
Correct,
East.
yeah.
And out of your total basket, 50% is exports, I think so. So in all, 30% of your total, revenues will be from West Asia and Middle East. Is that correct?
That's correct. That's correct.
All right. What about some of that stock that was already en route? Has it reached the destination? Or, because there has been a lot of problem on the logistics fronts as well. Is some of your, sales still stuck midway or some other port? Kandla port is what you mentioned. But at some, foreign base, is there some inventory that's stuck up there?
No, so Middle East is actually not a very long transit route. Maximum, 5 to 12 days is the maximum period. So I don't think anything on waters is an issue for us because everything was about to reach or will reach in a couple of days. So I don't think that's a concern. More of a concern is cargo which is lying at the port, which is custom cleared, which will incur demurrage and all those kind of things. So we are already in talks with APIDA and Ministry of Commerce to facilitate the trade in supporting with these costs. So that is what is going on right now. But yeah.
What could the quantum of those costs be, the demurrage charges and, the cost of that cargo staying at the port itself?
I mean, again, it's a matter of time, couple of days, it doesn't matter. But if it goes on for, multiple weeks, then it will be a cause of concern.
And you won't be able to pass it on to the clients?
Depends. Some clients might be able to, but for us, as a company, it will not matter because we have distributors across. We're not dealing with direct buyers or something like that. So it's our own brand. So we might be able to pass it on. But see, we consider our distributors as our partners, right? We don't want to pass on the unnecessary cost. So till the time, what we are suggesting our customers is that if they have stocks, they should wait for a couple of weeks for the situation to calm down, and then we can resume new shipments. So it's not, we're not trying to create panic for the buyers as well. So we are managing stocks in that way.
So you've stopped production for the entire Middle East basket, and plus you're sitting on a large cargo at the airport. Is that correct, Akshay?
Oh, no. So large cargo at the port would be for the industry. For us, it would not be a big quantum, but production has been stopped. So that would be a concern, yes.
All right. And that would be about 30% because that is the exports to the Middle East. Correct? Approximately.
Annual basis, 30% of our revenue gets impacted.
All right. Thank you very much for joining in. Great conversation and providing that perspective. But back to the market and no recovery as of now. Nagraj Shetty, Senior Technical Research Analyst at HDFC Securities, is now joining in on the show. Nagraj, 533 points lower. What is the advice on the Nifty?
Hi, good morning, Reema. Market is just echoing the global uncertainties and rising geopolitical tension. The supports are the levels where the market is penetrating day by day on the echo of the global concern. I think the overall chart pattern is indicating weak bias. And if you deep dive into our long-term charts, which is indicating the recent decline that started a few sessions ago from the higher levels, is we are in a last down leg of the whole thing before showing any bounce back. I think I must say that 24,000, 24,100 should act as a good base for the market to give a decisive bounce back from the lower levels in the near term.
Okay, Nagraj, I want to ask you about the Nifty Bank because the Nifty is trading below most simple moving averages. But the Nifty Bank is still 2% away from its 200 DMA. Do you think going by the price action, we're getting there as well? So another 1,000 points down on the Nifty Bank is possible?
Yeah, it is rightly possible because the bank Nifty has been in a outperforming phase compared to Nifty over the last few months, and higher tops and bottoms indicating the strength building up in the Bank Nifty recently before showing decline from the higher levels. I think there is a higher possibility that 200-day EMA somewhere around 57,600, 500 level is going to act as a base for the banking stocks without falling at the lower levels.
Okay, all right. You've got a couple of picks for us, so let's get straight to that.
Yeah, I have two picks. One is from strong stocks from either extreme. First one from a long side. If you look at Coal India, chartically it has been outperforming the benchmark as well as the sectors. Recently, we have seen some consolidation momentum. They try to attempt to break out of the consolidation. Currently trading around 2% higher during this volatile market, and trading around 435. The overall chart pattern is looking very positive, very resilient in terms of the global markets and the benchmark Nifty. I'm advising to buy at this point of time, currently trading around 435. The immediate upside target would be around 465 and can place a stop loss at 420 in the near term. Second one is from a weak side, JSW Energy. JSW Energy has been in a downtrend with the larger lower tops and bottoms over the period of time. Recently, it has finished the lower tops around the 506, 507, reacted down fresh in the last 2-3 sessions. There is a higher scope of further weakness in the stock. Currently trading around 466. One can look to sell this stock at right now, and the immediate downside target would be around 430. One can place a stop loss at 480.
All right, take that point, Rajesh. Thank you so Nagraj, thank you so much for joining in and giving us your views on the index and individual stocks. What we'll do is take a short break. On the other side, Manisha Gupta joins in with the focus on all things commodities. This as the Nifty is down about 553 points. We are seeing a deeper correction in the broader end of the markets, 2,500 stocks in the red. Is that likely to be further impacted by the rise that we're seeing in commodity prices? Manisha takes that forward.
Welcome back. Let's talk commodities. That's where you are seeing the brunt of the impact of Middle East. Manisha is now joining in with the big moves that we've seen there. Manisha?
Thank you so much for that. Should bring the crude prices on your screen right now because it has been a very volatile week. This one, we have seen $85 a barrel as well, which has been the highest since July 2024. We are up nearly 20% in this week for the crude oil prices. It has been a strong surge across crude varieties. So whether it's about WTI, Brent, Urals, Russian crude and the Middle East basket as well, all of that has been trading quite on the higher side there. It's not just the crude oil prices. It has to do with the gas, distillates, crude products. All of that has surged in the last couple of days therein. So when you look at the European natural gas prices, well, they are up by 10% this week itself. The US diesel futures are trading at October 2023 highs as well. And then you have the US gasoline prices. They are trading the highest since July 2024. Also take a look at the crack spreads or the refining profit margins as we call it. That also has been surging. That is highest since 2023 also. Well, a lot of that really depends on the oil supply disruptions and the Strait of Hormuz. So when it comes to Strait of Hormuz, Iran already has said that they will fire any ship trying to pass Strait of Hormuz. In the meanwhile, there are statements coming in from US as well suggesting that they will provide insurance and naval escorts as well to the tankers transiting through Strait of Hormuz. This is US International Development Finance Corporation saying that they would also insure some of these vessels. So that is a conversation that is happening at this point in time. But we do understand that major shipping companies already have said that they are looking to avoid Strait of Hormuz right now. Now, this is an interesting one. The supertanker cost in West Asia is now at an all-time high of $400,000 a day therein. I mean, these are the supertankers which carry 2 million barrels of crude at one time, and the cost therein has risen quite strongly. This actually is 50% higher to what we were trading in the previous week. Not just that, the LNG daily freight rates also have gained up by 40% in matter of a day and is trading at $60,000 therein, with markets anticipating that 100,000 perhaps is a possibility in this week itself if the Strait of Hormuz does not open, or as have been the statements, they are not carried out therein. Interestingly, it also has to do with the kind of supply disruptions that we have seen into the market. The vessel availability for March is seen tight due to backlogs. It was harsh winter in the month of Jan and Feb. And now with vessels stuck at Strait of Hormuz, the cost or the availability also is getting quite difficult. The West war has led to a lot of intensification in sense of shutdowns and precautionary shutdowns as well. So Iraq, which is number 2 crude oil producer in OPEC, has halted operations at some fields, cut production by 1.5 million barrels per day there. It also has to do with China, which has led to some refinery shutdowns, or they have brought their maintenance plans slightly forward currently right there. Qatar also has stopped LNG production. You also have Israel, which is stopping production in some gas fields. It also has to do with Saudi Arabia, which also has shut some refinery operations there. So many of these Middle East countries rich in oil and gas are shutting or partially shutting their productions there. Interestingly, when you look at the volumes therein, they have been pretty high. In various countries, especially in ICE, if you look at the overall volumes for crudes and crude futures and options, that has hit a record of 12.7 million contracts there. Also, the U.S. oil producers are rushing to hedge in long these higher prices, and that also has led to increase in volumes. Interestingly, the U.S. production right now stands at around 13.7 million barrels per day, and the markets believe that this is near peak. But it also is a belief that if this continues for another couple of weeks or so, then we are looking at the crude oil prices jumping beyond 85, 95 is the next level that the street is now talking about.
Thank you very much for that. The other big story is the fact that rupee has opened at a record low. It opened at 92.03, and since then it's been sliding. Lata is now joining in with more. Lata.
Well, it is a 0.75% loss because it is accounting for 2 days. We didn't trade on Tuesday. But if you count it from Monday to today, then the rupee perhaps has slightly outperformed other currencies, other EM currencies, because there has been a significant fall even in the ringgit, the Filipino peso, the Thai baht. All of them are seeing significant losses, equally dependent on West Asian crude, many of the Far Eastern countries. The demand for dollars is threefold, according to the traders. One of them is, the biggest demand is coming from FPIs who are, marching out of India. The second demand is coming from MSCI rebalancing. The rebalancing happened last week, but the dollar demand comes today or comes this week. And thirdly, the Reserve Bank had entered into a lot of swap agreements, swap arrangements to, stall the rupee fall in previous months. Some of them mature. That also creates demand for dollars. So it's really all-round demand. And if it has not gone far beyond this 92.18 where it trades now, it's because the Reserve Bank is believed to be supplying a lot of dollars. That's the market chatter, that they were selling dollars maybe up to $5 billion on Monday, and a large quantity is being supplied today as well, merely to quell the volatility and, to keep speculators at bay.
Thank you very much for that, Lata. The mid-cap index still down 1,200 points. Silver ETFs are in a free fall. We saw a correction in precious metals on the back of the rise in the dollar. HDFC Silver ETF grew Tata Silver all down 7-8%. And the other pocket of weakness on the back of Qatar halting LNG are many of these impacted companies. Petronet LNG has taken a hit. Gujarat Gas is under pressure. So that's a pocket you need to keep on your eye. And then you've got many other mid-cap losers like Rain Industries, 10% slide on very large volumes. Avanti Feeds, Apar, and L&T continues to be the top Nifty loser. Get into break. On the other side, Lata will speak to former Ambassador Naveen Suri, former HPCL CMD MK Surana about how the Gulf War may evolve.
Welcome back to It's the Economy. As the war on Iran becomes a general West Asia conflict, India faces a threat to its energy supplies as Iran shuts the Strait of Hormuz and Qatar stops LNG production. The key question for us now is how long may the war continue and how long can West Asia afford to keep the Strait of Hormuz shut? Actually, what are the options for India as well? To answer this, I have with me a renowned expert, former ambassador Navdeep Singh Suri, who was ambassador to the UAE and to Egypt, a West Asia expert. Also with me is Mr. MK Surana, former chairman and managing director of HPCL, and of course, the best expert on India's energy sources. Gentlemen, good morning and thank you very much for your time. Ambassador Suri, first to you, sir. Ultimately, the Gulf countries also depend very much on the Strait of Hormuz. It's their lifeblood too. Can there be a combined pressure to open it? What's your best guess as to how long we have to suffer that closure?
You know, Lata, we are at a stage where negotiations have broken down. We know that what the Omani foreign minister said, that they were very close to arriving at a resolution on the nuclear issue when the Israelis and the Americans decided to bomb Iran. In that situation, I think Iran, the regime in Iran at least, is fighting for its survival. And it is trying to raise the cost of the war for the United States and for all its allies in the region. It is trying to make sure that by the asymmetric warfare that it is pursuing, there is a hue and cry, there is an economic damage, there is a damage to the global economy, and hoping perhaps that its neighbors in the Gulf, whether it is UAE or Saudi Arabia or Qatar or others, will use their influence with Washington to tell Trump to back off, that this is hurting everybody around. At this point of time, where we are today, I think this could continue for a while, because for Iranians, it is a matter of survival. And, they have shown an ability and willingness to absorb pain and inflict pain and damage. It is currently in their strategic, perhaps, interest to keep this going until the pressures build up in the Gulf and in the United States itself.
Fair. I'll come to that, sir. Mr. Surana, to you, what options does India have other than the crude and gas from West Asia?
Good morning to you and Mr. Suri and all the viewers. So as Mr. Suri has rightly put it, the situation is slightly different than what we have seen in the earlier wars. Different both on the positive side as well as the negative side. The negative side is that earlier the Strait of Hormuz was never closed. And generally, the assets in the Gulf countries were not attacked. The positive side, if I see from Indian side, that our energy sources are more diversified, more in terms of source of supply, as well as the type of energy which we are using in terms of renewable, etc., especially for power generation. Second thing is, because our refining capacity has increased, the infrastructure also has increased, so we have got a larger way to hold the inventories. The third part is that just before the war started, in anticipation of a war, especially the Gulf countries, UAE and Saudi, has advanced the shipment. I understand that almost 1 million barrels per day of crude was shipped, higher than what they do normally in this month. The fourth part is that these months are basically a lower consumption period compared to, let's say, the same thing would happen in November, December. Okay. Now, the question is, what are the options which we have? So it is like a typical war room scenarios where the people who are not at war are affected more than the parties which are warring. And the scenario is not clear because the objective of the war is not that clear, and there are unanticipation and unpredictability to the whole thing. But there are definitely options, and we need not raise all the pedals together, but some of the options which I see is that because India diversified its crude sourcing, so we should try to tap those sources, which includes Russia also, because the situation is quite different. Second thing is, because there was oversupplied market and there was a lot of floating oil in the sea, something nearer to somewhere nearer to us in the Indian Ocean. And the company should try to hook onto that, and maybe that we may incur damages, but it will be good to own those oil if we don't have the place to store. That's the second thing. The third thing is that we have got a bit of a play between the raw material which goes in petrochemicals and the refining products, let's say naphtha and LPG. So because LPG and naphtha both goes for petrochemical, as well it can go for MS and LPG production. So it's the case with propane. There is some play available on that. Then because we supply our refining capacities more than the consumption, so we can see that whether the exports have to be seen. Of course, we import some product and export some product, so we need to see that.
Okay.
And the last part is that wherever we have got the allege in the inventory situation, we should try to fill it up, because we do not know how that goes. And depending on the situation, we need to put the pedals on the options which we have.
Oh, okay. That's a comprehensive understand 360-degree perspective you're giving us. Ambassador Suri, you've also been High Commissioner to Australia. And you have some sense of how much pain can the West itself take. We understand that, from production, crude to gasoline, it's about 6 weeks. And so the pain at the pump in the US itself will be felt post maybe 4 weeks is what we have been told. I mean, I'm just reading out from Google. what is your sense? When will pain at home push President Trump to, move towards an end?
I think, Lata, the problem from a US perspective is both the multiplicity and the lack of clarity on the objectives and on the end game. We have seen that it started with Iran's nuclear program. Then it went on to add missiles to the menu. Then it went on to talk about regime change. Then it started backing off from regime change with various formulations coming out from President Trump and the Secretary of State, Marco Rubio. Meanwhile, you have Prime Minister Netanyahu in Israel saying categorically that this regime change is what we've been waiting for 40 years. So I think the first point is the US willing to clearly identify what its objective is? When can it declare victory and take a walk back? Because what you very correctly said, that not only is the US willingness and ability to tolerate inflation at the pump a question mark, but also it's an election year. And with midterms coming up, and within the MAGA base itself, you will see these voices of concern increasingly getting louder, that this is not what we signed up for, to get involved in these foreign conflicts that come back and haunt us at home. So I think, my sense is that between the external pressures from the Gulf, whether it is Qatar or UAE or Saudi, each one has a strong and close relationship with President Trump personally and with members of his family. And the internal dynamics of US politics, you will see some kind of a crescendo building over the next few days that we need to find an exit option. The irony is that it's the Iranians this time who are saying that we are not interested in negotiating, right? And so it is now, the ball is back in the American court, and not only in the US court, but also for Washington to persuade Netanyahu that beyond a point, this is going to get counterproductive for everybody.
Best. So, Mr. Surana, I mean, this is maybe a slightly unfair question, but when does it start hitting the US gasoline prices at the pump? The guess of political scientists and people like Ambassador Suri is that when it pinches the US, there will be domestic pressure to hold back. What's your best guess?
I think there will be pressure more than the domestic pressure on US to try to have an off-ramp, because it is not only the gas prices, but there are the whole economy and the whole world is getting affected by that. And when you have, let's say, 20 million ton of LNG off the market, or let's say 20 million ton of crude oil off the market, so you cannot sustain it for a longer. So the question, it is the timing which will decide that how it hurts. It may be, let's say, weeks time, the situation may be different, the terms of negotiations may be different, and the reason to come off ramp may be different. But let's say more than 10, 15 days, it may be a different scenario altogether.
Oh, yes. So, Ambassador Suri, what little memory I have of the 1991 Iraq crisis and the 2007, Saddam Hussein issue, the US Army itself was in Iraq. And it was perhaps, Saddam Hussein's position was such that you could find an alternative. But here it is a whole clerical, the order in Iran. It is 50 years of rule, which means it's fairly entrenched, and the Revolutionary Guards are practically into the economy, into the society, into the religious institutions. Is there even a possibility of, a counter force emerging in Iran, no matter how much the regime may be hated?
Yeah, and absolutely. And I think one would think that the US would have learned lessons from Libya, where it was easy to remove Gaddafi and much harder to put a government back in place. Libya is still in a mess 30 years later or 20 years later. Look at Afghanistan, 25,000 American casualties, $2.3 trillion spent, and the Taliban are back in Kabul. Look at Iraq, again, 20 years of conflict, and $2.5 trillion spent, 35,000 US casualties, and you get a product like ISIS out of the power vacuum. So I think the US really should understand that this notion of regime change in distant lands doesn't really work. I think there was a sense of hubris after the quick success in Venezuela, but Iran is a very, very different cup of tea. And I think they are beginning to realize the pitfalls. And from a US perspective, I think boots on the ground is probably going to be the worst case scenario. And they would be really foolish to get into the exact fight that the Iranians will be looking for. That a fight which is much closer to their terms in the cities, in urban areas. So I don't think any American military planner is going to relish something after their experiences in Mosul and elsewhere. What they've experienced there.
The top guns in the US have repeatedly promised that it will not come to that. Marco Rubio said it very explicitly. So hopefully
so then we are leaving it to Mossad and CIA to foment enough of an unrest within Iran to achieve their objectives. But unfortunately, the IRGC and the Basij are the guys with the guns.
I agree. Sir, just a monosyllabic answer because I'm totally out of time. Very unfair, but I'm still asking you, your best guess on when we may see the war winding, Ambassador Suri?
Several weeks.
Several weeks. That's what, 4 weeks?
Hard to guess, but I would say several weeks, depending on the factors that I've already outlined.
Yeah, fair enough.
External pressures versus domestic pressures in
Fair
the
enough.
US.
Yeah, Mr. Surana, your best guess?
Anything more than 2 weeks will have the incremental cost. So I think there will be extra efforts to at least have some part, especially the one which is affecting the oil and the state of homes, some resolution reaching within less than 10.
We are just trying to guess, I think, the ability of the world to take pain. And that will be the time when perhaps the war will end or at least wind down. Thank you very much, gentlemen, for helping us understand both the energy ecosystem as well as the political international relations ecosystem. Wind up on Bazaar Chartbuster Summer.